I'd like to introduce our next panel here at the Planet MicroCap Showcase. We're very thankful. This is Friedman LLP. I think you're Friedman LLP. This is your eighth year now as a sponsor of our event, as well as Marcum, as well as Weinberg. This is the first year with Eventus, so thank you for sponsoring us this year. So, with that, I'd like to introduce our this panel is titled Accounting Best Practices, and will be hosted by Neil Levine from Friedman LLP. Neil?
Yes. Good afternoon, everyone, and welcome to the SNN Network's live conference and the accounting panel, Accounting Best Practices. I'm honored once again to be the moderator of another SNN event. Friedman LLP has been the lead sponsor for SNN for the last 8 years. First off, I'd like to thank my esteemed colleagues who I've been fortunate enough to discuss current accounting events that are happening as to best practices. Each one of the panelists will have a few minutes to tell you about themselves, their special areas of service, and what they do. I'm Neil Levine, the co-leader of the SEC practice since 2014 of Friedman LLP. We're a firm of 750 employees, started somewhere in 1924, like almost 100 years ago. Our SEC practice has grown to number 12 in the country with the amount of registrants that we service. We handle clients on all the national exchanges, the OTC markets, and some international markets as well. We have a large international practice, as currently we are number 4 world ranked in bringing clients to the national exchanges here that have their operating subsidiaries in China. With being the largest independent firm of a world body of accounting firms, of which we're represented in 93 countries, and there are 441 firms that we can rely on if we need services to service the clients. So finally, Friedman, with the help of this conference, has moved up to number 33 in the top 100 firms as we relate to revenue. And the Vault rankings came out this week listing us as the 11th most prestigious firm as it relates to culture, prestige, and diversity. So with that, I'm going to introduce my panelists. Corey Fischer, the managing partner of Weinberg and Company, David Grossman, an SEC partner at Marcum and Company LLP, Sokhi, an SEC partner at Friedman LLP, and for the first year, oh boy, we're going to have Neil. I'm going to call him Reithinger, but he'll tell you his real name. So with that being said, Corey, let's hear a little bit about you and your firm and what services you provide.
Thank you, Neil. It's great to be back here again in person. My managing partner, as Neil said, name's Corey Fischer from Weinberg and Company. Our firm is based in Los Angeles. We have offices in LA. We have offices in Florida. We have offices in Asia. Our firm focuses primarily on audits of middle market public companies. We've been doing it a long time. We have a very experienced group of ex-Big Four partners that work with us. I myself not only have a Big Four background, but also was CFO for a couple of different public companies back in the heyday of the internet crazy days. I think because of that, we bring a good mix of public and private expertise to our clients. I'm glad to be here again and look forward to the conference.
Thank you. David?
Sure. My name's David Grossman. I'm the assurance partner in charge of the Houston office for Marcum. Marcum is currently the 15th largest CPA firm here in the U.S. We have about 30 offices in the U.S., a few offices overseas, and about 2,600 professionals across the U.S. And my primary practice is in the SEC auditing. In the Houston office, about 2/3 of our audit clients are SEC registrants or companies that are trying to get there. And in addition to the operating public companies that we serve, Marcum also serves a significant number of SPACs. For this past 10K season, we had over 330 SPACs that we did the audits for. And in addition to the operating companies, I think the total is right around 500 total public companies. So when people ask me what my industry expertise is, I tell them it's really not an industry, it's really the SEC accounting and reporting. That's really what we focus on, trying to eliminate those comments from the SEC to get registration statements declared more quickly, and then also to keep our clients out of trouble. And similar to Corey, I spent 10 years in industry, so I think, again, that experience on the other side of the table helps us help our clients in things outside of just accounting and financial reporting.
Great. Neil Reithinger here from Eventus Advisory Group. Thanks for having me for the first year. Thanks for mispronouncing my name.
I do it
Over the
every
years.
time. Sorry, Neil. But we do a lot of work together, and we're thankful to have you service our clients as well.
Well, thank you, yes. And happy to work with Marcum as well on clients. So correct pronunciation is Reithinger, so we give him a hard time for the rest of the conference. We are a CFO firm with a full service accounting, financial operations, FP&A, strategic CFO, and also SEC compliance and reporting. So we are not an attest firm. We don't want to be. We complement very well companies by not being independent. We are obviously, in that way, we complement working with auditors as well because we have a synergistic, role we play. So we are a virtual firm. The nature of the specialty, even though I'm from Arizona and originally came family from New York, is that the specialty that's required for what we do in each one of those verticals of the CFO office is not something you can find in any particular zip code. We look and we employ people, about 45 people that are specialists in the areas of accounting, controllership for FinOps, FP&A. Our directors, our CFOs have to be strategic, and our SEC practice is all recovering auditors, I call them, but former auditors. So. But that is that's how we'll continue to build it. That's even pre-COVID. Okay, so we also have an internal control practice and a director who manages that for companies scaling their SOX practice. And I would say, with what we do, it's an inherently embedded role. It's not something you can scale very easily. It's not somewhere you can do, okay, I'm going to do this package and work. You have to maintain a team. You have to be embedded with the client. You have to be, as I call, in the foxhole with them and make them feel like you're there for the long haul. And as they grow, they may want to hire people permanently, and that's fine. But we want to enable them and to be able to scale in the meantime and actually find that for them to help them do that as they grow. So we're happy to work with these two teams and so on, and look forward to the panel. Thanks.
Ro?
Thanks, Neil. So my name is Sokhi. I'm an audit partner in the SEC practice with Friedman. And I'll keep it short and sweet. I think Neil, you did a good job kind of, explaining what Friedman does. But so my background is primarily SEC companies, PCO-based, IPO, companies that are already public or companies that are looking to go public. And I think, David, as you mentioned, my expertise, I'm kind of a generalist. So what that means is, I'm primarily, my expertise is in SEC. So from a firm perspective, with Friedman, we do it all. It's almost a 100-year-old firm, full service tax advisory and audit. And, I think, so we've been growing fantastically right over the past few years, and I came on very recently to Friedman from a Big Four, so there's quite a few of us. And yeah, we're looking to grow and make the firm even stronger.
Great, thanks, guys. So, Ro, because you had such a short opening, I'm going to give you the first question.
Okay.
There's many investors at the conference and many private companies looking to go public. So what are some of the different ways companies are considering going public, pros and cons, IPO versus SPAC, the old reverse merger.
Right. I'll definitely need some of that extra time that I got for this question. So basically, I mean, it's the holy grail for a lot of private companies looking to, to get to, right, to eventually become a public company and get access to the U.S. capital markets. So the most popular way and the way that most people know of a company going public is a traditional IPO. So that's an initial public offering. So that's essentially a private company, issuing shares in exchange for cash in order to go public. So there's benefits there for companies. That means, management has the kind of flexibility in terms of when they execute that, and it's great for companies that are, established or doing well, right? If they're doing well, more likely to get underwriters and be able to raise the capital that they need. Some of the cons are obviously that it's very expensive and can be very time consuming. So, I mean, it can take up to 12 to 18 months in order to go public. And maybe some of the smaller companies may not have the expertise or the kind of bench to be able to get access to that capital. So some of the smaller companies may look to alternatives to go public. And one of those is a reverse merger. And they were quite popular some time ago, maybe 20 years ago. And what this, the way it works is it's essentially a dormant company or a company, kind of a shell company that exists, and a private company will acquire that. And in a legal kabuki, they'll eventually become the trading company. The benefits there are the cost. It's lower cost, right? It's essentially the cost to buy the company, and as well as some legal costs. Some of the other benefits are if you're looking to maybe you're not kind of cash flow positive or what have you, less likely for underwriters to kind of stop the process if you're going that route. Some of the negatives, there can be sometimes skeletons in the closet for some of these dormant companies. I once had this client that essentially there was 2 SEC fraud investigations that they were not aware of. They had to resolve that before they could, essentially continue. So that ended up being something that took their focus away from their business. So a cleaner way, and a way that we are probably a lot more familiar with these days, is the SPAC. So a SPAC essentially stands for a Special Purpose Acquisition Company. And the idea here is that sponsors and investors will invest in a company, and that will be the public company. It's kind of a shell company. And they will look for a target company to become so operating company will become the public company. So the pros there are it's much quicker, right, than a traditional IPO. You can, if everything goes well, 3 to 6 months. Less costly because you likely, unless you're looking for PIPE funding, which is kind of outside the scope here, you won't have to go through the costs of underwriters. So the cons can be, quite a bit. So you likely, as a management, you may not have the opportunity to dictate the timing, right? You have to wait for a company, wait for a SPAC to acquire you and to be interested in your company. Share dilution, something like up to 20% or more can be lost in that process. So if you're not comfortable with that, that's something you'd have to think about. And compressed timelines, those are good things, but for management, hey, if you're not ready to be a public company, if you don't have the right folks in place internally, externally, it can be kind of a problem. So you definitely want to get your SEC counsel kind of teed up and get your auditors as well. I think that's highly recommended.
Thanks, Fred. That was nice and long, right?
Very long. It's a broad question.
You're usually the long guy, but last time I think we spoke at one of these conferences was November, right? So what's new at the PCAOB or the SEC since we've spoken last time? What are the trends in the comment letters, what's going on in enforcement. Give us something.
Thanks, Neil. There's been a lot going on at the SEC, as you probably have noticed. The direction of the SEC is set by the current administration, as we all know. And because of the different agendas between the past and the current administration, there's been a lot of changes. One of the top agenda items for the current SEC Commission was to address the ESG disclosures, which I'm sure many of you have heard of but may have not actually seen. So ESG disclosure is the process of communicating a company's environmental, social, and governance policies and performance to the shareholders and stakeholders of a company. And until recently, there was no real guidance as to the requirements for these companies and for these disclosures. There was different frameworks done by the international standards, by the European board, but there was no clear guidance. On March 21st of 2022, the SEC issued its long-awaited proposed mandatory climate-related disclosure rules. These rules will probably have one of the most dramatic effects on reporting since Sarbanes-Oxley. They are quite extensive, and they're going to extend to all the companies. The reason why the SEC felt that this was so important was because they believed that there was threats to companies from global warming that fell into two buckets. First, physical risk to a company's operations and facilities by increased and extreme weather conditions. And second, risk resulting from efforts to reduce usage of fossil fuels and prepare for climate change. So the primary focus of the SEC is they want companies to disclose their direct and indirect greenhouse gas emissions, which are going to be known as Scope 1 and Scope 2 emissions, and as well as disclosing supplier and partner emissions, or Scope 3 emissions. And what's really going to be difficult is the SEC may require outside attestation of your Scope 1 and 2 emissions disclosures. So basically, the proposed rule is going to require companies to provide climate-related disclosures in a separately captioned section of the registration statement, periodic report, or perhaps even in their proxy statements. And then they're going to have to provide climate-related financial statement metrics addressing the impact of the various climate-related events in mitigation and transition expenditures, together with related estimates and assumptions, and a note to the company's financial statements, addressing the impact of line items in the company's financial statements. So you can see this is significant. It's going to be phased in starting in 2023, and it probably will extend to all companies. Now, this is an exposure draft, so it's out for comment, so it's not final yet. I'm sure there's going to be a lot of comments, and what will probably end up being the final rule will probably not, be what we just discussed, but it's definitely coming. So that is a major agenda item on the SEC. The other thing that happened recently with the SEC is that they came out with some sort of guidance on cryptocurrency transactions. Previously, you probably were aware that there was no accounting guidance, there's no auditing guidance, and really how to handle these transactions. It's quite complicated, obviously, but basically, the SEC has said that all these transactions, the assets and liabilities, have to be valued at fair market, which everybody really knew. So it's nothing new in that, but the real issue is, how do you determine the fair value of these instruments? So that's out there. If it affects you, you really should speak to the audit professionals or your advisors and figure out how it affects you. Second thing that's been happening is the SEC, not only do they have their own accounting releases, they also issue their directive through comment letters. Over the past year and a half, and I'm sure David will probably talk to you a lot more, the SEC was very active in issuing comment letters on the SPACs. And basically, we're rewriting the gap for SPACs through their comment letters and caused a lot of the SPACs lots of issues. The second major thing that's really been happening with the SEC that may have affected a lot of companies with China-based operations is that because of the continued problems of the SEC or the PCAOB doing inspections of the China-based companies, the SEC has made it very difficult to get financial statements or registrations of these Chinese companies effective. And the SEC has been issuing numerous comment letters to clients trying to do registration statements, asking for increased disclosures about the risk of doing business in China, increased risk because you're a VIE, whether or not your auditor has the ability to transport papers over to the PCAOB. So if you have, and it's not just China-based companies, it's with companies that have operations in China. So it's been very difficult. I mean, we've seen clients that have had 8 or 9 different comment letters already, and just asking the same questions over and over again. So that's out there. So that's probably the major things that are going on in the SEC. You know, comment letters, pretty much consistent with the past years. You know, MD&A, non-GAAP measures. You know, you just got to make sure in these non-GAAP measures that, you know, you're following the right format. They're not getting, you know, any more prominent disclosure than the GAAP disclosures. Again, you know, segment reporting continues to be a hot topic of the SEC. They continue to ask these questions and causing companies to, you know, really look at whether or not they have segments. Revenue recognition. So the amount of comments have, you know, it's been pretty consistent for the last couple of years. PCAOB, you know, there really hasn't been any significant, you know, things going on, you know, other than, you know, again, the pending problem with the Chinese-based audits. And the audit problems really are for those companies that, firms that are not registered, that are based in China and based in Hong Kong, and that are not allowing the PCAOB have access to the work papers. You know, that's different than the 3 firms that are sitting up here because we're all US based, so there's not an issue if the companies use, you know, one of our firms. But if you are involved in a company based in China and they're not using a US based firm, there's going to be significant issues with the PCAOB.
Thanks, Corey. That was good. So Neil, as the non-auditor on the board here, for companies considering an IPO or a reverse merger, what considerations would you recommend them to prepare for such an event?
Well, aside from obviously having good financial processes, which are essential, and, you know, has the company done their bank recs and all that, we all assume that that's going to have a good financial team in place. It's really from some of the overlooked items, or maybe that are assumed not to be as readily apparent to identify ahead of time, is for things like corporate structure. You know, how many entities are there? Is this one trial balance, one entity, or if there are multiple, where are they located? What are they? What's the complexity of those? You know, it may be a very, common thing that corporations know in their day-to-day practice, but that has to be mapped out to know how to financially plan in the structure of an audit, because there's complexities in each one, as well as what is the ownership. If there's different ownership in each entity, the concept of VIE, not just a concept, but a very real issue with respect to how that needs to be analyzed, so that all that can be mapped out with a good financial plan. In terms of how to approach, prepare for an audit, prepare for transactions. Also, what kind of financings were there? Have there been, you know, equity-based financings? What's the history of those financings? How do we make sure we understand how does it roll forward so we have all the appropriate, you know, it's a big item on a balance sheet, which is often, you know, a holdup in audits to be prepared. You want to make sure that a process can start and not stop when you have all these things mapped out, right? Any debt-related transactions, anything affecting the financial statements that you may not even think is material, but that we want to look at that affects equity or could affect equity. Material transactions or significant transactions. Sometimes a lot of companies, it's just a standard agreement they have, but when you really look at and, peel the onion away there, you see that, oh, there's some commitments or contingencies or things underlying that agreement. Could be a distributor agreement, who knows? So a lot of these things just need to be brought to the forefront ahead of time so they can be properly analyzed. Related parties, you know, is there a, you know, common entities or people that a company may work with think that's just part of their common practice, but may lead to issues in terms of disclosure requirements. And all these things aren't issues. It's just a matter of identifying ahead of time so that there's a proper plan in place to in terms of how to go about preparing for an audit or the transaction itself. In other words, revenue recognition, you just brought up, hot topic, right? So all these things are going to require, fancy memos like these guys like to have. So a lot of these things need to be mapped out so everything can be understood. And then you can get into the micro issues, of course. Everybody knows you have to have a good general ledger and all these things, but these are certain that in terms of coming up with a 20,000-foot plan, you want to be prepared for it.
Great, thanks, Neil. So David, we know that Marcum is the leader last year in the audit of SPACs. So what is a SPAC? Explain what it is. And we hear this term Dspec. So why don't you give us a little overview on what's been happening in the markets regarding SPACs?
Sure. As I think somebody already mentioned, I think it was Roe, a SPAC is a special purpose acquisition company. And essentially you have a sponsor that creates a blank check company and raises capital through an IPO. And we've seen raises of anywhere from 50 million to 4 billion. And so it can vary in size dramatically. And then once that IPO closes, the SPAC essentially moves into the second phase of its life and searches for a target. So it goes through, identifies a target, does due diligence on that target, through regular M&A processes, evaluates if the target's business plan meets what the SPAC shareholders would be looking for, and then negotiates the terms of the merger, including things like employment agreements and who's going to govern the combined company and things like that. And then the last phase is what Neil referred to as the Dspec phase, which is the actual merger transaction itself. And so it's the closing of the merger, which requires a shareholder vote, and also the opportunity for those SPAC shareholders to redeem the shares. Because the key thing with a SPAC is all those IPO units, the money goes into a trust account, and those shareholders can get out. So they can redeem their units. And there's the possibility that a shareholder can vote for a transaction and at the same time redeem their shares. And over the last 5-6 months, the redemptions have been as high as 85%. So one thing to be considered on both sides, the SPAC side and the target side, is kind of a guesstimate on what that redemption rate's going to be. If it's going to be 85, and I think we've seen one of my clients, I think it was over 95% redemption. And if the target is relying on a certain amount of cash to come into the combined kitty, if you will, then the combined entities need to raise that money a different way rather than rely on the money that came in through the IPO. And that's where the PIPE transactions become very important, especially in the current situations that we're in. And then part of that Dspec phase is also legally the public company is the acquirer, but in the accounting world, it's just the opposite normally in the SPAC situation, in that the target becomes the accounting acquirer and actually becomes the registrant. And then upon closing, hopefully there's the right amount of cash there, and then they can essentially implement their business plan.
Yeah, David, nothing to do with accounting, but I personally purchased like 5 SPACs this year because I thought I was smarter than everybody. Beachbody, DraftKings. Why have none of these companies, why have they lost so much market value since they went public? And, they get Shaquille O'Neal. They get all these crazy people on the board. Did they take, did they sell their shares? Did they drive the price down?
None of the celebrities should have sold their shares because they would have been insiders and they would have been locked up. And the reason that the values in the SPAC world have come down is because last year, I think there were over 600, I forget the exact number now, of SPAC IPOs. And so there's a lot of money chasing a finite number of transactions. And because of that and the potential of the SPAC not being in a situation to merge with a target company has driven those prices down.
Thank you. All right, so let's talk about something else. Let's talk about COVID-19. So my kid called me this morning. He goes, Daddy, after 2 years of being a teacher, I finally think I have COVID. So Ro, what have the audit firms done? How have they conducted audits without being on site? What problems have we encountered and we're still encountering because of COVID-19?
Yeah, thanks, Neil. So, it's great to be here in person, and it can definitely feel like the pandemic is over, but, COVID-19 is still affecting us, right? It's still affecting our financial statements and still affecting the way companies are operating. So, just an anecdote, initially, we would always do inventory counts on, in person. And, a few of our clients, we started doing it by by Zoom, because that was the only way we could get access, especially in, early 2020. So, the things that I think the management needs to be thinking about, especially today, are, accounting estimates. I think that's one of the bigger areas that is probably still relevant. Anything that relies on future projections, those are, inherently soft and becomes even softer when you've got a global pandemic. So, are there impairments in your goodwill and intangibles? If you are taking an impairment in 2022, was it this year, or should it have been taken last year? Do you have a restatement issue? So these are all things, management will need to be thinking about and getting. If you got an accounting advisory firm working closely with, and definitely discussing closely with your auditors. Of course, allowance for doubtful accounts is another example. I mean, if you've got a big balance of accounts receivable, is it collectible? If it's not collectible, and should have been written off this year or last year, going concern is always something you want to be, that is prevalent for, especially companies that may not have, be cash flow positive. So, especially during a pandemic, I think that puts more pressure on that. And, so one thing to keep in mind is, right, management needs to have a plan around going concern, right, about their ability to continue as a going concern. And that's not from, if you're at 12/31, that's not till the next 12/31, that's 1 year from the date that the financial statements are issued. And then, the other, another key item that, a lot of firms were dealing with, a lot of audit firms, was just from a fraud risk and just a non-compliance risk, especially with all the money that was coming out, all the different incentives, the PPP loans. How should all of that be, accounted for? I think some of that has kind of subsided now, but those were definitely things that firms were thinking about.
Great, thanks, Rob. Corey, can you speak about the importance of having a competent, diverse board, and how has this impacted your clients?
Well, as part of the tidal wave that we're going through here with the increased ESG disclosures, there was a substantial push for more board diversity. It really almost started in the state of California, where in 2018 they passed a law to advance equitable gender representation on California corporate boards, requiring public companies to have at least one woman board member, and that number is to increase as the board size increases or as the company increases. Then it got expanded into 2020, where the California legislature passed a rule that required a minimum of one director from an underrepresented community to be on the board by the end of 2021. The California court just struck down this law as related to the board diversity, but it's still being implemented by a lot of companies. So that's on the state level, but nationally, NASDAQ has also now required that all operating companies listed on NASDAQ's exchange be required to disclose diversity statistics regarding their board of directors, and they've actually produced a board diversity matrix template, which they have posted on their website, which companies are supposed to use to indicate the diversity of the current board. They require companies on the exchange to disclose the ethnic and gender makeup of the board and to have at least 2 diverse members of the board. And if they don't, then they have to disclose why not. So that's a pretty significant change in a lot of the boardrooms. I think one of the effects of these new rules is that more previously unaffiliated and independent directors are joining boards. So as you can imagine, this is making for some quite interesting dynamics on some of the boards, where previously most board members were friends and families or people that were kind of just there to fill board seats. So that's definitely changed. Still, overall, there's nothing better than having a competent, respected board, and I think hopefully this is where we're going to get to. But it's certainly a big change.
Yeah, thanks, Corey. So Neil, as the third-party consultant up here that's not independent, where do you see the best practices essential to support a company's reporting process and your interaction with the auditors? I mean, we rely on you and we have great relationships, and you have these memos, and just tell the audience what your thoughts on.
Love doing the memos, Neil. Love those memos. I think there's, three areas. And first is leadership. What is leadership? Every part of a company needs leadership with respect to strategic development and where its plan is, leadership in marketing, if you're in marketing, companies in marketing. But with respect to what we're doing and how we interact with the auditor, we need to lead the process. The company needs to show that it's got the fortitude and the plan, and even down to a Gantt, as far as doing a Q. You only got 45 days to deal with, right? So we like to make sure that we pick an early date to file. Hopefully, and nothing's down to the wire. A lot of times things end up at the wire. I don't know why, but working backward from that. What do the parties need to do? What's a division of labor? When does that first draft need to turn? When is it so that we can be supportive of the audit process? So then they pick up that pen and they start. Once that clean trial balance and the financial statements are delivered, they don't have to stop. We want to make it efficient. And I think without planning with anything, you just need to, a lot of times there's nuances with it. Things don't go as planned. Sometimes you're a day off here, but you got to start and have that target in that plan. So the other thing is being predictive. We have to go into and understand and be collaborative with the company as they're doing their work, as they're running their business, and see what their transactions are and say, oh wow, they did a financing and there's a warrant out there that's going to need evaluation. That's our responsibility to make sure that we look at what that is ahead of time to prepare it so that it's ready for when it's going to be scrutinized, when the auditors look at it. That's something they need to look at. It may be a challenging topic too, and we may want to have a discussion with them, but they need to see our case first and the company's case and make sure that's prepared. And then I'd say, along with all those, the preparedness in every fashion, making sure that we're always, how are your financial processes, can we help? We've got our team that can do that as well. Obviously, a sound monthly close process leads to a sound quarterly close, and therefore that you're going to have, you go into your SEC reporting timelines and your audit knowing that you have that sound process in place. So a lot of these three areas are fundamental topics, but when you look at the detail of each one, it really requires, and I would say leadership stands out the most, because in that regard, that allows you, that forces you to have to say, these are our financial statements, even though it's theirs. We treat them as they're ours, or that's what any consultative party has to do, so that it gets done on time and it gets done properly. Okay.
Yeah, thanks. So I'm going to switch it up a little bit. David, difference between an emerging growth company and a smaller reporting company, right? So this is a MicroCap conference. So does a company have a choice to pick one or the other? What's a confidential filing that I hear about? Maybe you could talk about that.
Sure. Well, most companies going public, they start out the gate being both an emerging growth company and a smaller reporting company. To be an EGC or an emerging growth company, there has to be less than just over $1 billion in annual revenue. And to stay there as an emerging growth company, the company cannot become a large accelerated filer, and they can use the advantage of being an EGC in that status for a period of 5 years after the IPO. A lot of the things that the EGC was availed early on, the smaller reporting companies also have the advantage of doing today. The one big difference between emerging growth company and a smaller reporting company is the EGC is allowed to defer the adoption of the accounting standards to be similar to the adoption that private companies, as far as that time frame. So that the latest example would be the lease standard. And so the EGC was able to defer the lease standard, whereas the regular smaller reporting companies had to adopt the lease standard year before last, I believe. And then the difference between an EGC and a smaller reporting company is smaller reporting company is defined by having a public float of less than $250 million, or if the revenue is less than $100 million, the public float is less than $700 million. And a year ago, I actually had a client that stayed as a smaller reporting company because their public float was just under 700 million. I think it was like 693 million. And the advantage there is that they don't have to have an audit of their internal controls over financial reporting, and their deadlines for reporting of the 10Ks and 10Qs stay at 90 days and 45 days as a smaller reporting company. And then as part of the EGC initiation, the SEC also came out with the ability to file confidential filings, which are also known as draft registration statements. The SEC changed that, I think about 4 or 5 years ago, that all companies now have that availability to file confidential statements. And what it allows the company to do is to file that draft registration statement for review by the SEC, and the SEC does it on a confidential basis. The filing doesn't show up on Edgar right away until near the end of the registration process. So it gives the company a little bit more flexibility in planning for the offering, so the public isn't aware of the registration statement, possibly the terms of the financing, and by putting that stuff out there and with a long registration statement process could adversely impact the offering itself. And so that's the advantage of using the confidential filing. And we see that both in the operating company world and in the SPAC world. I've had SPACs do confidential filing and amendments to those confidential filings at least 2 or 3 times before they actually file the live filing.
Yeah, got it. So before we do questions and answers, Ro, I have one more question. There are people here from that have dual listings, and they're on the Canadian exchange, and we met a nice lady from Canada this morning. So very quickly, what are some of the advantages, disadvantages to do your dual listing here and in another country? Capital markets, what are we talking about?
Right. So, I mean, I think the clear answer is dual listing gets you access. So if you're a Canadian company, and you list in the United States, you get access to the U.S. capital markets. If you're thinking about Canada, if you're thinking about a Canadian and U.S. listing, you have options, right? You've got you can either file in U.S. GAAP or IFRS. There are some technicalities there. So, for example, if you are listed in the U.S. and as well as in Canada, you can file Canadian financial statements in U.S. GAAP. Likewise, if you're a foreign filer in the U.S., right, you can file IFRS financial statements. So in the U.S. So that's something you'll want to think about. There's a lot of planning and strategy. Do you want to keep your financials in IFRS or U.S. GAAP? Either way, you're going to need a audit firm that's both PCAOB registered as well as registered in Canada. So definitely keep that in mind. You don't want two different auditors looking at the financial statements. So so when you're going through that process, definitely I think keep your, again, I'll kind of say it again, just keep your auditors in mind and keep them ahead of the process, because those are the guys that can slow things down sometimes.
All right, thanks so much. So with that, I think Lulu wants us to go to a question and answer, spend a few minutes.
So ESG, and let's just get down to this is just for not my partner over here, but for the all you attest firms here. How do you plan? And you probably don't have an answer to this yet, but this question that I'm thinking about how do you actually plan to attest on scope 3? Because I get you can attest on pretty much anything that the company that you're going into and proving out their admissions and however. But if I have a vendor and maybe they don't send me their scope 3 admissions, what happens then? Maybe it's just uncharted territory.
Hold on, let's see. Corey, do you have an answer for that?
Yeah, I think the SEC has said that they're thinking about, scope 3. I don't think it's going to get to that level, at least for a while. Okay, so I don't think you have to worry about it. It's going to be interesting who's doing the scope 1 and scope 2 attestations. I never learned anything about counting carbon emissions in my auditing classes. So
I can guarantee you'll get a division.
what's that?
I guarantee you'll have a division.
Well, absolutely, the big four. I mean, they're the ones that are pushing this. So, that's where it's going to come. Yeah, thank you. So, Corey, how can we get a hold of you? Yeah, sorry. But on our website and WeinbergLA.com. And please feel free to shoot me an email if you have any questions. David?
I'm at MarcumLLP.com.
Neil?
We have a booth here, and our website is Eventus AG for advisorygroup.com, eventusag.com.
Ro?
Yeah. So again, we have a booth here, Friedman LLP. My name is Sokhi. You can find me on LinkedIn, and my email is rsokhi@friedmanllp.com.
One more question.
Of course, this is going to be an ESG question, but I actually received a questionnaire from large New York bank that was probably pre-testing it, and to a scope 3 was asking what our paper procurement policies were, and did we have a good timber practice policy in place, which I'm sure is going to be a preface for a lot of the ESG questions that we're going to be getting. My question for you guys is, ahead of revenue, most of the RevRec stuff, there were advice coming from auditors or forensics or whatnot about what to start preparing ahead of time, such as getting sort of approvals or acceptance of satisfaction of obligations in writing, even an email to satisfy those. What are you guys recommending in the next year and a half to start preparing for this ambiguous and very comprehensive, and as I just found out today, extremely expensive scopes work, and as a MicroCap software company, disproportionately a burden to us?
So if you gave advice before RevRec, what are you guys saying? You guys need to start preparing the following for your 2023 audit.
Not like anything else. It's not going to be 2023 for the small caps. This is going to hit the big companies first.
But is it going to be large cap and the small cap caps, there's going to be an exemption to it.
No.
Well, that's Michael Cohen.
Yeah. I think you just have to monitor. This is something, this is evolving. And, but I personally think it's going to be like Sarbanes-Oxley. Well, it's going to hit the big companies first, and then it will trickle down to the smaller cap, and it may even in fact not. This is planned right now. The last I saw, planned implementation, if it's approved. This is still an exposure draft, number one. Number two, the PCAOB hasn't commented on it either. So, it's going to take a while for this thing to take shape, and then once it's approved, before it actually gets implemented, and then there's going to be lots of changes, and it's going to start at the top, with the big Fortune 500 on down. But that's all anybody can tell you right now.
So just a really quick one. Is it likely that IFRS will accept it first, and then GAAP would be delayed similar to what happened with Red Rack?
IFRS has nothing to do with this. This is an SEC. This is coming from the SEC.
It's carrying over, particularly for those of us who are cool.
Exactly. There's 15 different standards out there on ESG from the international community. So I have no idea what those rules are. Obviously, the Europeans have been way ahead of this for a while and have been requiring this, but I don't know what the governance is there.
Okay, thank you very much, everyone, and we'll see you next year.